About a week and a half ago, producer prices came out for the month of September, and it was overall a mixed bag. While Wall Street basically cheered because final demand inflation was the lowest month over month inflation rate that they had seen all of the year 2021. As you can see throughout 2021, it wasn't that much lower. It still came in at 0.5% month over month, which is annualized over 6% inflation for final demand goods, which, as I have mentioned, that's just one stage away from the consumer price index inflation. Now, consumer prices right now are having a yearly annual inflation rate of 5.4%. In the meantime, final demand has been consistently over that 5.4% on an annualized basis. And that should be able to push up the consumer price inflation index even further. One of the things to note here is that while Wall Street may be concentrating on final demand, they're taking their eye off the ball off of the entire producer price index for all commodities. In other words, they're ignoring what's going on in the earlier stages of production. And that's key here to understand, because the earlier stages of production in terms of producer price inflation will dictate the later stages of inflation later on with final demand. So while producer prices for commodities calmed down in August, which is probably why we saw final demand inflation drop a little bit in September, they did push back up in September. They pushed back from 0.7% to a 1.1% inflation rate. So annualized, that's a 13% producer price inflation rate. And that will more than likely have some upward pressure on the PPI for final demand. That will more than likely push that up. And we can see this pronounced jump back in intermediate goods, which is really the earlier stages of production for the producer price index. And it jumped back from 1.2 to 1.4%. So in the earlier stages inflation here is still really high, and it's well over 10%. It's actually pushing about 14 to 15% inflation here. And sooner or later, that inflation will come down to the consumer price index. The major thing that has been holding back consumer price inflation is that wage inflation is not matching this producer price inflation, okay? Wage inflation is not even matching consumer price inflation. But once that happens and those wage inflation rates start setting in, it will then build up that consumer price inflation index. Until then, for a time, I would expect that producer price inflation will remain significantly higher than consumer price inflation, but that can only go on for some time before businesses have to raise those prices, and then that will trigger wages to start matching that inflation rate. And it's already happening now, where more and more workers are leaving their jobs for one reason or another, and the only way to keep them now, to retain talent, is going to have to be to mark up wages significantly higher. The most dangerous part here, though, is that final demand and the consumer price index on a year-over-year basis of percentage change has shown a significant divergence. We've never seen this in the past 12 years of accumulated final demand numbers here, okay? So we have looked at final demand numbers for over 12 years, for over 11 years at least, and we have never seen a year-over-year change in final demand deviate so much from the consumer price inflation index. So the largest drop I've seen, or change, has been a 1.8% differential year over year. And it has been blown out of the water by this jump in final demand cost that has risen by 3.2%. So one of two things is going to happen, as I've mentioned and alluded to before when I noticed this last month. Either those final demand inflation rates are going to come down, or that consumer price inflation rate is going to go up. Yet, because intermediate goods inflation is bouncing back, I expect final demand inflation to keep pressing along and pressing upward. As a matter of fact, my projections for final demand by the end of this year is to wound up at 9.4% inflation. And even though right now tracking the CPI, it's going to end up around 6% inflation, maybe a little bit more, it will track more or less closer to final demand, and there won't be so much more of a deviation. And that can spell a serious issue going into 2022, because sooner or later those two variables have got to converge. Now, my guess is that we will eventually see a calming down in final demand inflation, but also a rise in consumer price inflation as businesses have been hesitant to raise prices. But when we go into the winter with energy costs surging, as well as splurging on Christmas and a demand to pay at any price to get Christmas presents to put under the tree, that can definitely cause this surge in consumer price inflation, which would throw off my projections a little bit and put us more in line with final demand. Does that mean I'm thinking that we're going to see consumer price inflation of 9.4% by the end of the year? Highly unlikely, but I do think that it is still possible we could see consumer price inflation surge up to, say, 7%, possibly even 8%. It's just that this divergence is extremely abnormal right now, and it shows you that there's disconnections going on in the supply chain prices. Sooner or later, those businesses are going to have to mark up the prices on the consumer price index, and that's something to keep an eye out for as we expect to see this compensated. One of the things I think that is it can account for this divergence is that shelter inflation is not keeping up with the regular inflation rate. So shelter inflation right now comprises a component of 1/3 of the CPI, and that shelter inflation, it supposed to take into account home prices as well as rental prices, yet it really compensates with home prices by using owner's equivalent rent. They send out a survey to homeowners and say, what would you rent your house out to be? Instead of trying to gauge and say, what's your mortgage payment or anything else like that. But even when you take into account rental prices here, they're showing that the annual inflation rates for shelter components, including rental rates and homeowners inflation, homeowner equivalent rates, is less than what the annual inflation rates we were seeing in 2019. Yet when we look at the S&P housing prices, the inflation rate for those housing prices are significantly higher than what we were seeing in 2019. Look at how much the curve has steepened on those price increases compared to 2019. So there's definitely a huge disconnect. So while the inflation rates here were more in line, similar to what was going on in the shelter component of the CPI, meaning it was hovering around 3.3%. What we are seeing here is a huge deviation between home prices and that inflation rate that has been going on inside that shelter component. Is there always a connection? Well, no. I mean, look at what happened with the housing bubble here. But to me, that tells me that the Consumer Price Index report is kind of missing these gaps here, these rising steepening prices. And of course, rising home prices isn't going to dictate everything, but it does tell me that the CPI is probably missing on this by a good significant bit. And that's probably what's explaining that deviation between final demand and consumer price inflation. But I don't think that's going to be just all of it. I don't think that that's the reason why there's just a total, all of it at 3.3% differential. But I do think it's probably some of it. So I think the CPI will probably end up around 7 or 8% by the end of the year, depending on how things are going. And that can be a major concern, as the surprise may jolt Wall Street and may cause a winter sell-off in the markets. Now, taking a look at my final demand model that's been going on. So last month, the final demand model was off by 0.3%, but was well within the model's norm. I had forecasted that the year-over-year rate would be 5.7%, so we would see a 0.7% monthly jump in consumer price inflation. We didn't get that. Instead, we got a 0.4%. So and it raised it to 5.4%. So it was a little bit. It's still surprisingly overshot the CPI inflation rate again. Looking at final demand for October and how that's going to project CPI inflation, I do think that for the CPI for October, it'll be 0.7%. That's what the model's showing. At the very minimum, it'll be 0.2. At the maximum, it'll be 1.2. So I think we're going to get around that 0.7% inflation rate again. And I would not be surprised if we overshot that as we start seeing some compensation for the lag in inflation rates in the previous months. But that's what I'm looking at. That's what I'm seeing right now, guys. Once again, I thank you for watching this video. I'm sorry I haven't been able to produce videos earlier when this information came out. There's a lot to go and digest this week. This is going to be a busy economic week, so I'll definitely try to post and catch up with you. Life has just been a little bit busy for me this week, as I'm sure it has been for all of you, trying to keep up with what's going on in the markets today, as well as with our lives. So, guys, thank you for watching this video. If you like it, make sure you click that like button, subscribe to my channel if you haven't already, and as always, click that notification bell so that way you're notified when I upload new content. And I will talk to you next time.